Have you ever considered investing in property, physical property, for investment purposes? Are you eyeing a potential investment opportunity but you're not exactly sure whether it's a good decision or not? Are you struggling to calculate exactly what your return on the potential investment will be? In this week's episode, I'll help you and assist you to crunch the numbers to determine exactly what your return on a potential investment property will be. You do not want to miss this episode, so let's get stuck in. My name is Dr. G and welcome to this week's episode of the Financial Dispensary. In this week's episode, we're going to delve into an area that I feel that a lot of people struggle with, and that is how to calculate and determine what exactly your return will be on a potential investment property. I'll give you a very practical example of an opportunity that I literally discovered just now, and we can go through the example on a very practical way to show you exactly in terms of what variables you need to consider in determining whether it's a good investment opportunity or not. So let's get stuck in. So I currently reside in Stellenbosch in South Africa. Now Stellenbosch is a fantastic, quaint little town nestled in the province or the area that they call the Boland in the Western Cape. They've got a university, so it has a fantastic property market because every year you have this vast number of students flocking to the town to attend the university, and for that specific reason there's constantly a demand of new people moving to the town, people that come here to study and then potentially also don't leave, then they just stick around. So what I did is I kind of just did a quick search on Property24, an online portal that you can utilize to determine kind of what investment opportunities there are available. And I literally just did a search. My criteria was that it had to be between the price of 1 and 2 million rand. It was just a random number that I decided on, and I landed on this specific one. So let's quickly look through the pictures. You can see obviously it's a sectional title. All the units look very similar in nature. Looking at the apartment or flat, I can see it's nice and light and bright. Lots of natural light. The colors of the walls being also nice and light. I get a warm fuzzy feeling. You can see the nice kind of the contrast of the plants with the green and the wood. Getting a good vibe from this apartment. The kitchen, obviously it's not top notch, but definitely not too bad. Looking at the bedrooms, more than sufficient again. So let's say I'm trying to target that specific, the potential student market. Very nice. That's probably the second bedroom. More than sufficient space. Nice built-in cupboards as well. In the bathroom, basic, but more than sufficient again. Oh, that's the second bedroom, I presume. All right, so let's look at the details. So you can see, unfortunately, because the property market is so robust in Stellenbosch, it comes in at an eye-watering 1.84 million rands. It's only a 2-bedroom, as we saw, 1 bathroom, there's parking space for 1, and 65 square meters is the size. Reading through the description, the things that I pick up, obviously it's prime property located on campus between Merriman and Victoria Street, so hence the reason for the hefty price tag. It is a very central kind of location. 2-bedroom duplex, that we said. It is adequately suited to appeal for first-time buyers or investors seeking to expand their rental portfolio. Wow, bang on in terms of what we're trying to do. Property is zoned for commercial as well, which is interesting, but we most likely will use it for residential purposes. Virtual tour, and the first important number that it brings me is that there's a current rental income of 11,900. We'll get back to that number. So on Property24, it also gives me some very other important numbers that we'll need to include. So the first one is the price per square meter. That's literally just taking the listing price divided by the 65 square meters. It comes in at 28,000, which is probably on the high end. These days, kind of sectional title apartments, or most likely probably close to about 20,000. But obviously, because this is in a very high demand kind of area, it comes in at 28,000 rand. Levies, which is the important part, at 2,600 rand, and rates and taxes at 760 rand. So those are all kind of key variables that I need to do when I start crunching my numbers. The other important thing data points that I can see on property 24 is that based on that purchase price, my monthly repayment would be 20,000 rand per month. So I need to be able to have that amount of free cash flow available in my budget. The other important thing is to qualify for the bond, I need a gross monthly bond, or the income, or dual income if it's between myself and my spouse or partner, at 66,000 rand per month. And very nicely, they also tell you what is the bond and transfer cost. I'm going to need that data as well. The bond and transfer cost on 1.84 is 109,000 rand. So these are all kind of very important numbers that I need to gather in my quest to determine whether this is a good investment property. So that gives me a very good kind of framework in terms of determining whether this is a very good kind of investment opportunity for me to invest into. So next I'm going to jump into this specific, it's a software solution that I bought many years ago. It was developed by Dr. Hannes Dreyer. It's just a glorified Excel. So I'm going to walk you through step by step all the various variables. You just need to build either your own Excel or reach out to me, and I can put you in contact in terms of buying this kind of software solution. It's a glorified Excel to assist you in crunching the numbers. So the first step would be to kind of insert all the important details. So the first important kind of assumption that I made is that the purchase price, let's say the potential seller would be happy to sell it at 1.8 versus 1.84 million. I'm not going to put down a deposit on the investment. The other costs is the important one. That was that bond and transfer cost of 105,000 rand. So obviously I see this quite a lot. It's very important for you to plan for that initial kind of bond and transfer costs. So remember, when you purchase a new property and you need to register a bond, there's certain costs incurred in that registration process. And you also need to pay the transferring attorneys to transfer the property onto your name. So just going back to that property 24 calculation right at the bottom, what are the bond and transfer costs? There it gives you the very nice breakdown. So the bond registration breakdown is about 41,000 rand. That's just a guideline. There is a specific guidelines that the lawyers need to stay within certain bands, but 41,000 rand would be the amount that it would cost to register a new bond on this property, and then 68,000 rand would be the cost to transfer the property onto your name. So we have that figures, so we're going to put that in. I slightly reduced the 109 to 105, knowing that I would only offer 1.8 million. The next variable, and what you'll see is I'm going to run through all the various variables that we're going to insert in our calculation, and then go back and amend some of the variables to determine what are the key areas that you need to focus on in deciding on which property to purchase. So the first one was the interest rate at 11.75. That's currently the prime interest rate at the moment. And I also made it that the term is for 20 years. So obviously remember, you can register up to a bond term of 30 years. But because this is an investment property, I decided to go on the lower scale of 20. The next one is what is the kind of estimated inflation rate. So I specifically went slightly higher at 6.5% was my inflation rate that I worked on. And I'll show you in terms of why that would be important. Next, there's a lot of other variables that I'm not going to include now, but that you could potentially include in further calculations, just to show you how granular a specific investment calculation can go. So the first one was with regards to the depreciation. So remember, from a tax point of view, you are allowed to depreciate certain fixtures and in the property. So effectively, you can write off the value of the new stove that you inserted in the rental property over a specific period. Next one is a very important one, which is the capital growth rate. And all that means is that what is the average or estimated increase in the value of property, the capital value of the property over a long period. And all that I did is I literally just, again, did a bit of a Google search. 6%, as I said, was a conservative average estimate for this specific market. So in good markets, you'll have a higher capital growth rate. And in kind of less ideal kind of property markets where the property market is struggling, you'll have a lower and potentially even a negative kind of capital growth rate. But because because it's in the Western Cape and the Boland area, and because it's linked to Stellenbosch with the university, it's got a very strong capital appreciation rate of 6%. So I worked on 6%. Next one, monthly expenses. So these we got from the actual property 24. We know the body corporate or the levies is 2,700 Rand, and we know that the rates and taxes is 760 Rand. So levies is the amount that gets paid to the body corporate for managing kind of the body, the entire complex. So that would be things like gardening, security, general maintenance and upkeep. And the rates and taxes goes to the municipality for all the services that they need to deliver. Renovation costs own, if there was any. So was it necessary for me to kind of to spend any money? Again, just going back quickly to that kind of pictures. Gosh, looking at that pictures, I don't think I need to spend a cent. It is in fine form. The outside looks pretty, the inside looks pretty, so no renovation cost. You can also add the renovation cost if you need to do it against a loan. Again, it's not going to be applicable. Repairs and maintenance not applicable. Special expenses, there's no special expenses. Tax obligations, this is a very important one. So let's say for whatever reason I want to buy the property in my personal name. You can add in what your annual taxable income is, the reason why the calculation asks for your annual income, let's say it's 500,000, is to determine what your marginal tax rate is. And I'll show you when I do the calculation in terms of what that is. So the reason why they ask this is just to determine what your tax percentage is that you need to pay tax. Management expenses, so am I going to utilize the services of an agent or somebody else to assist me in renting out the property? And let's say yes, and I'm willing to pay 10% of whatever the rental income is. The vacancy rate I'm going to leave specifically at 0. So you can also budget that the property will be kind of vacant for a month, a year as an example. But because, again, it's in prime position on campus, I'm targeting the student markets, and I know every year new students will come. I worked on 0. Additional loan payments, are you going to pay off the bond quicker, yes or no? Let's just leave it at blank. Capital income is not applicable. Rental income is obviously the important one, and again the property 24 ad specifically mentioned there is a rental income of 11,900 already in place. So I can budget that in place, and then the question is just 11,900 is the rent that the current owner is charging this year. What do you think you'll be able to charge next year? And again, based on a bit of an assumption, I said that I can increase my rental income by 7% per year, slightly higher than inflation because of the location of the property and, well, location. And there you have it. So you can see everything on this left-hand side is all the specific variables and the data points that you actually need to do a proper calculation in terms of what the actual value is or the return profile of this specific investment. So I'm going to save this investment now, and I'll show you in terms of what the numbers look like. So I'm going to zoom in nice so that we can have a nice kind of big picture in terms of this. So there's obviously, you can work on specific years going into the future. I'm just going to focus on this first 5 years, and I'll show you in terms of why the first 5 years are the important one. So property value. The property value means that, remember, we bought the property, made the assumption we bought the property at 1.8 million. Based on that capital growth rate, it means 1 year later that property will be worth 1.950 million. And that's effectively the purchase price that we purchased plus its 6% escalation. Loan amount, so remember we had to take out a bond of that 1.8 million. At the end of that year, we're still going to owe 1.776 million to the bank, which means the difference between what the value of the property is and what we owe to the bank is what we call the equity amount. So that's the actual value that we've accumulated in that property in the first year. We know that our gross rental income is at 11,900 per month. We just times that by 12. Then in terms of the loan, we know that whenever you pay back the loan, there's going to be the capital or the principal amount and then the interest. Obviously, in the beginning, you'll see that the interest amount is going to be the biggest component. So 210,000 of our repayment will be interest and only 23,000 will be income. Will be the principal amount. Hence why, remember, we registered the bond for 1.8 million. We pay back 23,000, but we still owe 1,776. Total loan payment is that 234 per year. So remember, the property 24 calculation said it's going to be roughly about 20,000 rand per month. So 20 times 12 is that 240. None of these other expenses were applicable. The property expenses, so remember, you're going to have to pay the rates and taxes. You're going to have to pay the body corporate, your levies. That's the 41,000. So pre-tax cash flow is going to be minus 147, and it makes sense. So remember, we're going to get the income. So the tenant is going to pay us 100 and let's call it almost 130,000 rand. We're going to have to pay the bank nearly 240. So the swing between those two already, just about 100,000. And then we still need to pay the city and the body corporate another 40. Hence why the pre-tax cash flow is 150,000. So when you crunch a number, I'm just going to pause on that number. That's a very important number. It means, although on the bond calculation, we need to budget for 20,000 rand per month, based on the rental income that we're going to get out, minus the amount that still needs to go to the body corporate and the city, we need to budget for that 100, let's call it 150 odd thousand. So you can see that's substantially less than the 20,000 that we initially budgeted purely for the bond, because this is investment property. So when you look at your actual cash flow, that should be the bare minimum that you need to kind of be able to afford. Initial capital outflow of 105,000. Let's see if you can remember what that is again. You're correct. It's the bond and the registration fees that you need to pay the lawyers prior to the registration. So then the calculation does a pre-tax cash on cash. So money in, money out, and obviously that number is going to be still horrific because you're going to have to pay the lawyers, the 105, and you're still going to have to fund 150,000 out of your own cash flow. So that number is just looks horrendous. Total taxable deduction. So this is the important one. So what does that mean? So again, what is allowable deductions that I can deduct? Well, my interest payment is allowable deduction. That's 210,000. And my property expenses is allowable tax deduction. That's 41,000. Combine the two together, 251,000 is my taxable deductions. The taxable amount, well, what is that? Well, that's my income, the 128,000, less my tax credits that I have for deductions. So the taxable amount is actually a negative amount. So instead of me earning money, I'm actually investing money for a future date. And that means, depending on my tax, on the sliding scale in terms of where I land in my marginal tax rate, I can actually get a tax credit of 38,000 rand. And how that works is, if you comply with all the requirements, I can effectively, that taxable amount, this deduction of 123,000, I can offset against the other 500,000 that I earn on my day-to-day job. And that's going to yield a tax credit of 38,000. So my actual after-tax cash flow is only 108. So remember, it's that 150. That's the actual money that's going to flow from my bank account. But at the end of the tax year, SARS is going to deposit 38,000 rand into my bank account, which is then mean that I only need to budget for 108,000 rand. So if you can see, if you can start bringing it together, to qualify for the bond, I need to have disposable income of 20,000 rand. my gross income between me and my spouse needs to be about 66,000 Rand. But it's not going to be the 20,000 Rand that's going to flow every month because of the rental income, but less the other expenses. It's closer to 150,000 Rand per month, which is on cash, but prior to tax. And if you include tax, there's another odd 40,000 Rand saving, which is that I only need to actually have 108,000 Rand money on a monthly basis. But again, the numbers are still negative, so on a percentage base, it's still horrible numbers. The income per month now, and that's at 108 divided by 12, is 9,000 Rand that I need to budget for over the entire tax year, taking tax, the income, the expenses, everything into consideration. And here we finally get to the important number, which is the IRR, also known as the internal rate of return. That is a number that you need to look at and consider when you evaluate an investment property. Obviously, it's still negative and it's nearly 13%. However, you actually need to look at the 5-year numbers when analyzing investment property. So if you take all of these variables, you can see how many there are, and extrapolate this now for the next 5 years. So we know that the property value will increase by 6% per year over 5 years. You'll be able to increase your rental income by 7% per year. You'll never have a vacancy, so obviously that's an important kind of swing. You need to pay the bond, and it's at a high interest rate currently of 11.75. What else? We know that the levies and the rates and taxes will increase as well. But if you look at all of those numbers, you can see how the numbers then pan out here on the right-hand side. So I'm still negative 7,800 Rand per month that I still need to invest on a monthly basis into the property. But if we include everything, so money in, money out over that specific 5-year period, we get to a value of 8.03%, which is not too bad. And there is the magic number. When comparing this specific investment, 8.03% is the internal rate of return that this investment property could potentially kind of achieve. And then obviously jumping into future years, you can see how slowly but surely the internal rate of return here at the bottom continually increases over time. And that's based for a very simple reason, that initial cash flow, that 105,000 that we invested on day one, we're moving further away from it, and that the income that we're able to generate grows faster than the expenses. So you'll see that year over year, slowly but surely, that internal rate of return will increase over time. So 8.03, to kind of summarize it, is this kind of investment a good property? Is this property a good investment? Well, it's actually not too bad. However, if I quickly just jump over to kind of Investec, one of our corporate cash management accounts where we do a lot of kind of cash investments, you can see that you can easily earn closer to about 9% on your capital, whether it's at 105,000 Rand or the monthly amount that you invest on a monthly basis, and you have zero headaches. You don't have to deal with agents, things breaking down. Inevitably, there's some mental hard work and some emotional toll on you investing in property. So based on that number, knowing what we are able to get by just putting money in the bank and kind of sleeping easy, I would at this stage not recommend somebody to invest in this specific property now. That IRR is unfortunately just too low to make this a very enticing opportunity. However, let's crunch and play around with the numbers slightly and see what should be the ideal scenario for this investment to be a good investment opportunity. So I'm going to go back to the edit the property. Probably, in my view, the single biggest investment or the variable that will have a big impact on you on this investment property becoming a very viable opportunity is the purchase price. So remember in my example, the listing price is 1.840 million, and we said we made the assumption that the owner will maybe settle for 1.8 million. Let's just see if I change that to 1.7 million. So we know that the the market value is closer to 1.84, but let's say this is a very motivated seller that needs to get rid of the property ASAP. Let's just look at that IRR. Remember, it was 8%. Now it jumps up to 13%. If this was a scenario, and if that seller is willing to sell the property at 1.7 million versus 1.8, it's definitely deal on. 13% is obviously a very much more juicy and much more a higher investment return versus the kind of money in the bank or money with Investec at the moment. So that's the first lever that you can pull, that 13.21%. Another very important lever that you could pull is this capital growth rate. So let's make the example. Let's say you are situated anywhere else in the world and you are unable in your immediate market are unable to get a 6% capital growth rate. Let's say you're not such a fantastic place and you get a 3% capital growth rate. So let's see what the impact is of the capital growth percentage on the investments. Remember, it was 13%, drops down to effectively negative, almost negative. And hence why you've heard this a lot of times, but people will continually kind of push this kind of this mantra: location, location, location. The location of your investment property is the single biggest, or not single biggest, but one of the biggest variables to determine in terms of whether it's a good investment opportunity or not. So if you're unable to buy in Stellenbosch, but you in another town, only a 3% difference in capital growth rate makes a dramatic impact in terms of your investment opportunity. So please make sure that you do proper analysis in terms of this capital growth rate, and that you have the right, or you invest in the right area. So I'm going to change that back to 6%. Let's see which are of the other kind of variables are still the important one. Obviously things like the rental income, being able to squeeze out a couple of, instead of 11,900, maybe 12,000 or 12,100 will make a big difference. But it's not going to make, on a percentage base, it's not going to make a big difference in terms of your IRR. This is the third one that I wanted to zoom in. So remember, the assumption was we registered a bond, and the bond was at prime, 11.75%. Maybe just before amending this, I'm just going to jump back to the summary again, just to show you exactly where our IRR is at the moment. It's still at that 13.1%, because remember, we've got a motivated seller willing to sell it at 1.7, not 1.8. We're still in Stellenbosch, so we still have that capital growth rate of 6%. But now let's say you negotiate a bit with the bank, and you are able to show the bank that you are a very credit-worthy investor. Apologies, it's jumping around a bit. And instead of 11%, you can get it down to prime minus 0.5. So instead of 11.75, let's go down to 11.25, and let's see what the impact is that on your internal rate of return. So remember, we were on 13%, now jumping up to nearly 14.5%. So there you have it. These are, as I said, it's a specific software solution that we have access to assist in calculating that kind of internal rate of return for clients. I think the key takeouts that I want you to take away from is that it is possible to calculate exactly what your internal rate of return of a potential investment property is. A lot of people, I think, when deciding in terms of investing in property, they kind of go with a gut feel, or with something that the agent tells them or their friends tell them. By having access to all the information, I can tell you and show you exactly what your internal rate of return is. So you can calculate and then compare it against alternative investment opportunities. Leaving the money in the bank, investing it in shares, and so on and so forth. So you do have that capability. The second, I think, big takeaway is that it is a complex calculation. So yes, you can calculate it, but it's a complex calculation, and you need lots of variables and lots of inputs to be able to determine a proper calculation. the age-old mistake that I see what a lot of people do is that they buy a property for R1 million and then 5 years later sell it for 1.4 million rand, and then they say, this was a fantastic investment opportunity. I bought it for R1 million and I sold it for 1.4. Never taking into consideration all the millions of other expenses that they incurred during that 4-year period that actually made that to be a horrible investment. So please make sure that you analyze and incorporate all of the assumptions. So yes, that software solution is maybe slightly more advanced, but you can reach out to me or my team and we can assist you in terms of crunching that number. It is just a glorified Excel, and you can effectively repurpose that software solution to assist you in calculating what the exact internal rate of return is. So there you have it. A quick fire way in terms of to calculate your internal rate of return. So again, 3 key variables if you want to squeeze additional juice out of your potential investment property. Buy from a motivated seller, so buy it well below market value. Negotiate very hard with the bank for the absolute best interest rate. And location, location, location. Make sure that you invest in property that's in a high valued area with a high capital growth rate. If you're able to do that, you'll not only be able to get into the property market, but you'll be able to stay in the property market as well. And there you have it. Thank you for sticking around till the end. If you have any questions, feel free to drop it in the comment section. If you like the value, if you like the content and the format in terms of how I produced this very practical kind of example, be a pal and smash that like button, and also share this to family and friends and ping that notification bell. I endeavor to provide you with valuable, practical financial advice on a weekly basis to level up your financial life and to get you growing towards financial independence. Until next week, thank you. Goodbye.